My name is Tony Panagiotu, President of Panagiotu Pension Advisors, or PPA. I've been a practicing retirement plan attorney and CPA for the last 30 years. You've worked hard to build your company or professional practice. And on top of all of the other business or state taxes, there's also income tax. Now, there's nothing wrong with paying your fair share of taxes, but is there anything that you can do to legally ease your tax burden? Well, the answer is yes. In the next few minutes, we're going to show you how a cash balance plan can save you hundreds of thousands of dollars in federal income tax. Let's talk about the basics. A cash balance plan is a type of retirement plan that is used in addition to your company's 401k plan. Depending upon your age and compensation, you may be able to save 2, 3, or 4 times as much as you would in a traditional 401k plan. So here's how they work. First, a cash balance plan is a separate plan. And unlike a 401k plan, it has a mandatory contribution feature so that if you decide to adopt a cash balance plan, you must make a contribution each year. Now, the IRS has a few rules. The first one is that you must have your cash balance plan in place for at least 3 years. After 3 years, you can elect to terminate the plan or change the contribution either higher or lower. In addition, the contribution during the first 3 years, although fixed, will vary slightly based upon the investment performance of the fund's assets. Let's look at this graph. When we set up a plan, let's assume that you are going to contribute $100,000 into the plan for the first year. For that first year, the contribution will be exactly what we calculated. In the following years, the contribution will be slightly higher or lower depending upon the investment results of the plan. The IRS mandates that the plan use a rate of return that is fixed and most often set at 5%. If the plan earns more than 5%, the contribution will be slightly lower. If the plan earns less than 5%, the contribution will be slightly higher. The most important thing for you to take away is the plan requires a contribution that will vary slightly from year to year. So when do I have to fund the cash balance plan? You must fund your cash balance plan by the time your company tax return is due, including extensions, but in no greater than 8.5 months after the end of each plan year. So how is this money invested? Well, unlike a 401k plan where each person has their own account, assets in the cash balance plan must be invested in one pooled account. These investments will be managed by your financial professional in a prudent and diversified manner. So what about the end game? How do we terminate a plan? Well, after the plan has been in place for at least 3 years, or if you have some sort of unforeseen business emergency, the plan may be terminated. At that time, final calculations are performed and each person's balance will be available for distribution. Participants may roll over their proceeds into the company's current 401k plan and IRA, or they can take the distribution subject to tax. Well, are there any other features I should know about a cash balance plan? Well, absolutely. Remember, this is a qualified plan, subject to the protections from lawsuits or the claims of creditors, and the earnings on the plan assets accumulate on a tax-deferred basis. Therefore, no tax is due until the assets are distributed in cash. Finally, funds that accumulate in a cash balance plan, or when rolled over to an IRA, are not subject to mandatory distributions until a participant reaches age 70 and a half. And only at that time are part of the assets required to be distributed based upon IRS regulations. Well, what about my employees? Do they receive contributions in the plan? Well, yes, just like with any IRS tax qualified plan, there are minimum coverage and participation rules we must consider. As a general rule, when you add the contributions you have already made for your employees into their 401k plan, when we add both plans together, employees will receive contributions that range between 7.5% and 9.5% of wages. The good news is you've already made material contributions to your participants. So the small incremental cost for your employees also allows you to leverage those contributions tremendously. So saving taxes is as easy as 1, 2, 3. Step 1. Decide the level of contribution to the cash balance plan. Step 2. Have PPA draft your documents and set up the plan account with your financial advisor. Step 3. Begin funding the plan. It's as easy as that. With your new cash balance plan, not only will you save significant income tax, but you will enhance your retirement savings in a tax-deferred and creditor-protected plan. You've worked hard for your money. Wouldn't it be nice to keep just a bit more of it? If a cash balance plan seems right for you, please contact the professionals at PPA.